focus on customer value, not shareholder value. This is something that Clayton Christensen said a couple of years ago in one of his pivotal articles that was published at Harvard Business Review. It's an article with the title The Capitalist's Dilemma, and it's sort of a play on a former article that he wrote and a book that he wrote actually called The Innovator's Dilemma. Now, Clayton Christensen is a big figure in our little universe, Orange Capital Partners. We use him as a sort of foundation of our principal stack. The Innovator's Dilemma is part of our principal stack, and not just that. I think overall his thinking, his philosophy, his thinking as a business thinker is very dear to our hearts. And we usually don't spend too much time with sort of business school academics because we believe that actually in line with what Clayton Christensen is saying in The Capitalist Dilemma, a lot of the business school academic thinking and a lot of the sort of business philosophy that comes out of business schools is probably very useful in terms of running businesses, but it's not incredibly useful in creating wealth and creating economic growth. And this is kind of what Clayton Christensen is discussing in The Capitalist Dilemma. And this is also something that we as investors are very focused on, which is when we invest in companies, we're mostly focused on customer value. A business that is creating customer value, that is compounding customer value, that is finding ways to grow customer value is going to grow with that. So returns and wealth are highly correlated with customer value, at least in the system that we believe in, which is a system of voluntary exchange, of entrepreneurial ingenuity, of creativity, of freedom of expression. So a lot of these things have to be given. Of course, this changes, let's say, in a totalitarian regime and things like that, but that's not what we're discussing here. We're focused on a system of voluntary exchange, of ideas, of free capital, of freedom of expression. And within that context, we believe that increasing customer value should be the absolute focus. And we want to discuss the recent price reduction of Tesla in China within that context, because we think that's the right thing. And we think that that is ultimately going to grow shareholder value, but in the long term. And this is the key differentiator. This is not even on podcast. It's January 7th, 2023. This is Crimdelco. It's a Saturday. There's no update. For the year, we are down 6.9%. The market is up 1.5%. We're underperforming by 8.4%. Tesla announced massive price reduction in China. We are very happy about that. We think that that's exactly what Tesla should be doing. Relentlessly drive down cost and be the cost leader and increase the relationship between customer value divided by total cost of ownership. This should be always the absolute focus, which is another way to say increase customer value. Now, I want to discuss this from a business practical perspective and then go into sort of more the academic conversation that also Clayton Christensen alluded to in his seminal paper, The Capitalist Dilemma. So first, from a practical perspective, we think that Tesla's innovation and mouth, which is basically the speed of innovation, should be focused and is focused, actually. I mean, I shouldn't use the word should, because it is really focused on increasing the value, the excitement of the car, the excitement of the experience of owning a car, and maybe add to that the energy product. So the whole business proposition of Tesla is not just the car, it's a whole business energy package. Energy independence, clean energy, and electric car with all the benefits that an electric car brings. And then within that also we have software, for example. So the actual software, package, which is the operating software in the car, which allows over-the-air updates. It's the full self-drive software, which allows for autonomous driving. And then there's also the software within the manufacturing space, which is the, let's say, automation of manufacturing and things along those lines. So those are all parts of the increase, so of the optimization, of the increasing of the customer value. Customer value is defined, again, is the value delivered to the customer divided by the total cost of ownership. So you can increase customer value on both fronts. You can increase value and keep everything the same, or you can keep value the same and lower the total cost of ownership, or you can do ideally both, which is increase delivered value, so better experience, more, let's say, more range, better torque, faster car, better experience in terms of harvesting energy from the rooftop, better battery experience, better, all kinds of things that increase customer experience, or you can lower total cost of ownership. Total cost of ownership, of course, is defined against by the price you pay for the car or the energy system, for the software. It can be the energy, more efficiency, so you have to pay less for electricity. You can lower the cost of electricity by increasing the harvested energy from the rooftop. You can decrease the battery cost. So there's a lot of things you can do on both of these fronts. And we believe that the recent price reductions in China in particular are a good sign and a good step in the right direction as far as going towards increasing customer value. So increasing that quotient, increasing either the value delivered or decreasing the total cost of ownership. And we believe that this is not just something that the company should be doing in terms of competitive response. Let's say in the case of Tesla, I think they made a mistake. They made a mistake because they started increasing prices about 18 months ago when inflation started hitting the global value chain. And we believe that that was a mistake for two reasons. Number one, it is the wrong signal. It is not according to the mission of the company to increase the adoption of alternative energies or to increase the speed of alternative energies. Or, actually the exact mission statement is to accelerate the advent of sustainable energy. If you raise prices of your cars, that is not according to your mission. So that was already sort of a red flag. The next red flag, and this is something that we closely monitor at Orange Capital Partners, which is really the competitive situation. In the end, every business is defined by the competition that it is exposed to. And no matter what you do, no matter what good you want to do to the world, if competition erodes your market share, if competition erodes your position in the market, then you're going to have a problem. So therefore, we believe that the absolute key focus, laser focus, should also be on how do we compare to competition. Now, for Tesla, this has often been a neglected point because they were so ahead of competition. But if you raise prices by 30%, which is what they did in most markets, not in China, but in most markets, and we're going to talk about actually other markets, particularly the US, a bit later. But if you raise prices by 30%, you're just opening up a window for competitors to step in. It doesn't matter how you look at it. It doesn't matter how bad the competitors are. It doesn't matter how how ugly competitive cars are or how bad their software is. If you raise your prices by 30%, there's more room for others to step in. And this is what happened in China, for example. We believe that BYD's success is partly driven by the high prices of Tesla, and that's what's being corrected now. The mistake that Tesla made is they should never have raised prices. Ideally, they should have kept prices the same and said, you know what, we're happy to give back to our customers, even though there is inflation. Inflation was caused by the wrong COVID response and all the money printing that was associated with that. We're not going to be part of that. We're going to give all those increases. We're going to absorb them and let the customers enjoy the low prices. Now, of course, in hindsight, that's easy to say because we now know that inflation peaked probably about 8 months ago and is now declining. So now you can say, well, it's safe to lower prices. And 8 months ago or 10 months ago when they started raising prices or whenever, maybe 12 months ago, that wasn't predictable. So they had to kind of catch up with the curve. They also wanted to reduce the wait times. What we're saying is they should have kept those wait times high. They should have kept the prices low and just pumped volume. Now this caught up with them, and now they're forced to lower prices. Now they are communicating within the Chinese market that they're doing that to help the China recovery and all that stuff, which is nice PR. But fundamentally, of course, people are upset. People that paid high prices are upset. Now that's going to abate, and it's all fine because in the end, lowering prices is a good thing. It's not a bad thing, and I think all the customers should be happy about that, even those who paid a little bit higher prices for their cars. Now, as far as other markets are concerned, we believe that the same should happen in the US, the same should happen in Europe. It's going to happen. I think it must happen. And the repercussions of that are, of course, margin pressure. Wall Street is not happy about it. Now, we at Orange Capital Partners are strong believers in the Clayton Christensen concept of customer value versus shareholder value. And that's not a political statement. It doesn't mean that we're against shareholder value or some sort of anti-capitalist doctrine. In fact, we're pro. We're investors, for God's sake. We're supposed to make money with our capital. We just believe that increasing customer value long-term will also increase our returns on our capital. That's all we're saying. The short-term stuff, the return on capital invested, the return on this, return on that, all these metrics that business schools and business people and business finance professionals use, they're fine because they are yardsticks, measurements for management in the short run. And they actually deter management from thinking long term. For example, this whole price reduction conversation we're having right now with Tesla is really a sort of a long-term view, right? Short-term, it's going to hit margins. Oh, that's bad for return on this, return on that. Oh, my EPS, my margins. Well, maybe. Yes, of course, short-term, it's going to hit my margins. If I lower my margins by 50%, they're going to be down by 50%. Gosh, it's math. However, long-term, I'm going to print volume, higher volume. I'm going to have rights law on my side. I'm going to have a higher monetizable base for, I have 2, 3, 4, 5 million cars on the road. I can monetize FSD. I can monetize insurance. I can monetize a lot of other things and therefore increase my cash flow in 5, 6, 7, 10 years. So, and in the end, what matters is the cash flow that a company can produce over the next, decades. That's really what matters. Not the next year, not the next 3 years. Now, of course, also, we're not going to think 300 years ahead because our lifetime's only 100 years. But we're going to be able to think 20 years ahead. That's fine. That is fine. That's not a problem. We're investing. We actually, Orange Capital Partners, always tell our customers, you're investing your newborn child's college fund. That's what you're investing with us. That's the kind of time horizon you need to have. That's when we can promise you the 15% compound return after tax, after fees. That's a very high return, even in today's high interest rate environment. Forget about the fact when interest rates were zero. That's a very high return, and we can only deliver that if we have this type of long-term view with wealth-creating companies. It's our job to find them and deploy the capital properly. It's your job to have cash on the side and cover your expenses and not use this capital. That's your job as an investor in our fund. Our fund's job is to invest the money and keep it with the kinds of companies that we think have that customer value maximization doctrine. And then things will turn out fine. So to summarize again, the conversation about lowering prices in China, we believe, is actually a very interesting case study in terms of the conversation that Clayton Christensen started about 8 years ago with his Harvard Business Review article, which is The Capitalist's Dilemma. What he spoke about is the fact that when we focus too narrowly on return on capital, return on invested capital, and those sort of things, that we're risking to actually reduce our return on capital because we're not doing the kinds of long-term investments that are necessary to succeed. Tesla is right now doing exactly that. It's reducing its return on capital or return on invested capital, the short term, the 1-2 year type metrics, for the long-term return, which will be much higher, which is basically in a nutshell, they're lowering prices in China, they will lower prices in the US and Europe, reduce their EPS and margins this year, next year maybe, but then long-term increase their cash flows because the monetizable base and rights law will be on their side, and therefore they will be able to generate higher returns. Thank you.